Hi guys, welcome to another trading basics educational video. This time we're going to discuss a topic that's a matter of preference. Many people are sometimes confused. Trading in the pre-market. What trading in the pre-market means? What are the pros and cons? Why you should or should not trade in the pre-market, and who's basically trading in the pre-market from the get-go, because we have from 9:30 to 4 p.m. that's 6.5 hours of market trading, and we have according to each broker, it depends anywhere between 2.5 to 3 hours of trading in the pre-market, and sometimes another hour to 2 hours, again depends on the broker, of additional trading in the aftermarket. So overall, if you think about it, 3 hours in the pre-market, nearly 2 hours in the aftermarket, you have 5 hours plus 6.5 hours, almost 12 hours that you can spend in front of the charts, trading, day trading, swing trading, starting your investment in the pre-market. Does it make any sense? Okay, let's first talk about the cons. Why not to trade in the pre-market? First of all, the volumes in the pre-market, I don't want to say 100% of the time, but 99% of the time will be way lower than the volumes in the during the market hours. I would exclude events where there are news specific to the stock or to the ETF that are happening in the pre-market, and that's something that we can discuss on another time. But overall, the volume in the pre-market versus the volume during the regular market hours, totally different. You can check it. I mean, there is no like a relationship like it's a 99% less or 75% less, but way lower, way lower. When I say lower, I mean 80 to 90% lower per 5-minute bar or 2-minute bar. Then we have the issues with the orders. During the market hours, we enjoy the market order, the stop order, the trailing stop order, the stop limit order, and of course the limit order. Other than the limit order, all the other orders which are market orders are not available in the pre-market. So let's say you enter a position in the pre-market long, you cannot post a stop loss. You enter a position short, obviously you cannot post a stop loss. The only way to enter a position is through a limit order. Now when you enter a position to a limit order, again the order may be accurate, but sometimes, again, because of the market is very illiquid, some of your position, if not all of the position, is not going to get filled if the market is moving very fast. Now the market can move also very fast against you, or you won't be able to exit the position. So again, looking at these variables of issues, it's clear that there is no edge in trading in the pre-market unless you are an expert, you know exactly what you're doing, and you proved yourself that you can trade in the pre-market successfully. Again, it's a tough market environment, no liquidity, lack of variable orders, no stop loss. It's basically something that I will say avoid at all costs unless you are an expert and you know what you're doing. Now what about the aftermarket? Same rule applies. Trading in the aftermarket versus trading in the pre-market, the volumes drop significantly. Let me show you, hold on a second before I move to the aftermarket. Is the price action in the pre-market indicative of the price action during the market hours? That's something that maybe I'll ask ChatGPT. No, but I have to answer according to my experience watching charts for 20 years. No, there's no direct correlation between the pre-market price action and the market hours price action. Now I'm just posting you an example where LTBR closed up 40%. That was the close the last time it traded, up 40%. What happened to the stock in the pre-market? You can see it actually moved lower. Again, the news came in the morning session, but again, you don't know when the news are going to hit. If there are news that are not planned, like earnings, anything can happen. Now, if there are earnings, and I will show you an immediate example what happens during earnings, the move can be also very, very fast. So if you're looking for a trade, you must be in a position before the move. Okay, but let's not discuss this right now. Let's look at the aftermarket in LTBR. Hold on a second. This is the price action aftermarket after the 40-something% move, and you can see there was almost no price action. Again, because the volume is very, very low, and you can see the difference between the volume during market hours and the volume in the pre and after. Spreads can open up significantly. The quantities displayed at each price level drop significantly, which makes for not an exciting, inviting trading environment. Like I said, unless there are news. One more additional thing that I want to add here is that when you trade in the pre-market or trade in the aftermarket, sometimes the brokerage fees can be higher. Again, it depends according to your broker. The brokerage fees can at times be higher. You also need to check on that with the broker that you are using. Now let's show an example where there are significant news, meaning earnings, in the aftermarket or the pre-market, because that's where the news are coming out. You know what, this is a tough one. Let me show you another one more interesting. That's ROST. ROST, it's Ross Stores, and this is the price action, and the stock closed down 10%. So that's the price action in the pre-market. So in the pre-market, you can see that the stock dropped after basically dropping in the aftermarket on Thursday. This is already Friday. So the stock dropped. You can see that there are at times minutes without any execution dropped, then spiked up, then basically moved from 130 to almost 140. That's a $10 move on no volume, and then it ricocheted back down. So again, there's almost no technical validity to patterns, although sometimes you can find stocks like let me see, like Nvidia or Robinhood or the leading ETFs that can display some technical patterns, but those are stocks that carry a lot of volume already in the pre-market. A normal stock doesn't carry, I don't want to say, the whole pre-market can sum up to maybe 500,000 shares, maybe 1,000,000 shares. That's equal to trading the first 3 or 5 bars in many of the stocks. So you cannot trust the technicalities. Spreads open up, not a lot of option in terms of orders, meaning only one type of order, which is the limit order. Bad execution, increased at times commissions. Overall, it's a no-brainer to summarize that the pre-market price action should be reserved for those who are prove themselves that they are very successful. It's of course very, very risky, and I would have to say that institutional traders, being that they trade a lot of shares, won't participate in the pre-market. Not all of them. I cannot make. I don't know who's participating actually, when and why. But most of the time, institutional traders are not going to participate in the pre-market game. Okay, guys, I hope it was illuminating. Thanks a lot for being here, and we'll see you in the next video.